Hello. Hi.
Morning.
Hello. Hi, James. Hi, Dudley.
Morning. So I thought I joined the wrong session now. I thought we were in a meeting. I'm finished.
I think, yeah, it's interesting. I mean, you can show. I mean, I mean, I think you've chosen. I mean, which is fine. I mean, it's okay. I mean, because I think Natalie's just logged in. I think it's Natalie, or it's either Natalie or Hannah, because. Hi, Natalie. Hello.
Hi, Owen. Sorry, I'm having a problem. My son used the laptop,
Yeah,
and I'm as Brad at the moment, so I'm trying to change everything. Sorry.
That's okay. That's fine. As long as you're logged in.
I am here, but
you are here. That's fine.
Weird name. Sorry.
It's okay. That's all right. Hi, James. How are you?
Hello. How are you?
I'm well. Yourself?
Yeah, good. Thank you.
Good stuff. Good stuff. Good
I'm
stuff.
back to normal now. Sorry.
Yes, it's showing as Natalie now. Showing as Natalie now. That's fine. That's all right. That's cool. Cool, great stuff. So I think we're just waiting. Yeah, we're waiting. Oh, in fact, you know what? Graham might have sent me an email. I might have missed it. But we're technically waiting on Graham and Hannah. Cool. How are you doing? I mean, wow, it is warm, isn't it?
Definitely.
Yeah.
Yeah. So for chai, because all of you, no, Natalie, you're in Portsmouth, but Dudley and James, I suspect you live in Chichester.
I'm in Pog now, personally.
Right. So you have a beach. You have a beach as well.
Yeah.
Yeah. There's a beach. And Chichester, James, you're in Chichester, aren't you?
No, I'm in London at the moment.
Oh.
Yeah. Bloody boiling. It's all right though.
Ooh, London. Oh, no way. Ooh. Now that will be a warm place to be in.
Yeah.
Ooh. I mean, London just gets warm anyway. You know, hi Hannah, hi Graham.
Morning.
Good morning.
Hi.
Hi. I'm just teasing James. He's in London. And I'm just highlighting that given that there's no water anywhere near it, well, I mean, there's just no breeze. It's just warm. I mean, it's just warm under normal circumstances. So, are you there for a while or just for the weekend or?
No, we came up to stay with family during lockdown.
Oh, okay. You mean you've been in London? Wait a minute. Have you been in London all this lockdown while? Sorry.
Yeah. Pretty much. Yeah.
Right. Okay. Oh, wow. Where in London are you based?
They live like Chelsea and Kensington.
Oh, well. Oh, that's not London. I mean, like, there's London and then there's just like Chelsea, like the greatest football club ever. Sorry, I'm getting carried away there. But
You're right.
Thank you. I mean, hey, Liverpool have won the league, and we congratulate them. But our day is coming. Anyway, before I get carried away, let's let's begin. I hope you're all well. And we are. Hannah, how are you? How's it going? How's the move? Where have you moved to? Where in the country are you based? Are you in Chichester?
No, so I was originally in Crawley and now I'm back in Rochester.
Rochester, help me. Wait, come on, where is Rochester? Like
Kent.
Oh,
most people know Maidstone.
This gets even more interesting. So you work. Where's your firm?
Dorking, sorry.
Right. Okay. So how did you come to join us through your association with James then?
Yeah, so I was living in Crawley and I thought I'd be able to
I get it.
do the commute, but then we decided to move to a bit of a bigger place because we were only in a 1-bedroom flat.
I get it.
So we moved to a house, and originally I grew up in Rochester, so
I get it.
we moved back.
It's all making sense. And given that we are online, it doesn't really matter where you are. It's just whatever happens in September, the commute will be crazy, but we will see and discuss what goes on there. But no worries, awesome, great. So yeah, I mean, you do have a bit of a beach there, because can't wait. You can, if you were to look for a beach, what would be the closest beach to you? The sort of
Probably Herne Bay or Margate.
yeah, I was going to say Margate is your way, but at least you have a beach. It's warm. I mean, like I went running along the beach this morning, and it was just littered. I mean, everyone. I mean, it was so busy yesterday, the day before. The guys have been out there cleaning up the. You know, people are just going crazy in the heat. So hopefully, the rains come to cool things down a little. Cool, great stuff. So let's carry on. We are. I mean, because Graham, you're in Chichester, aren't you, Graham?
No, I'm actually in Bognor.
Okay, right. So you guys have a beach as well. So that's quite good. That's quite good. Cool, great stuff. So what was I saying? Yeah. So we are now. So my plan, what I was hoping to do, like I said, we're going to carry on with the next chapter. I mean, I have the PowerPoint slides, and again, forgive me. I've been teaching advanced tax to the, well, you know, James knows Zach's class on Wednesdays, and I mean that's just the syllabus is unbelievable. I mean, I thought tax was big, but advanced tax just won't stop. It just keeps going. I keep wondering, when will this book end? So I haven't had enough time to look at my emails. So just in case you have emailed me, I will catch up with all of those. If you like, with any questions, if you have. I think I checked on Monday or Tuesday, but I will check up on those. So what we will do is we will we looked at procedures last week, and what I will do is I think we did procedures, then we did some questions on procedures last week. So what we'll do today, we'll carry on with the next chapter, which is really the second to the last chapter. I think we'll finish it, and then I think what I might just do is just finish off the syllabus the following week, reporting, which means that I will then have a good 6 to 7 weeks for us to just go through questions. So even though I know we're not in class, I probably will kind of be chasing you up a bit more during the week for questions and for us to analyze the questions. But I think we're doing well for time. And again, all the videos are recorded. You can always go back and review the material. So let's kick in. I thought to kind of, I don't know, I just felt like, I know it sounds a strange thing to say, I didn't really feel in a PowerPoint mood. I don't know why. I mean, I've got the PowerPoints, but I thought the chapter itself lends itself to just walking through and talking through it. So I was just going to go through the chapter, the material. I mean, most of the time I am almost rewriting what I see. But the thing is, it feels a bit FR-ish in that there are examples for us to actually do, which I will do. So I'm going to go into the textbook itself as opposed to send you. I mean, I have the slides, I will send them, but go through the textbook and walk through it. So you'll see that it's not as, it's actually, we're getting to the bit of audit where we can start to sort of think about what's going on. We're like, okay, but we will keep on, what we need to keep on doing is the meat of audit exams. Think of audit exams as in, I need to understand sort of the ethics and assurance engagements and corporate governance, one big bulk. I need to understand how to read through a scenario and pick out audit risks and make kind of recommendations as to what we're going to do. And audit risks, including control risks, if you like. I need to be able to carry out audit procedures, and then I need to be able to deal with what these last two chapters are about, how to decide whether or not we will tick the box that the audit is true and fair, and what I do at the end of after I've finished all my procedures. So that's kind of if you start to get that picture in your head, you know, you'll be all right. Right, let's go. So let me share my screen. So let's go. Like I said, I'm going to walk through. Oops, sorry. I'm going to walk through. Here we are. Share screen. I'm going to walk through chapter 11, is where we are. Completion. And like I say, you know, I've always enjoyed teaching audit in the summer term, in the March term, because we can talk about it. It's not as intense. I mean, I'm teaching tax right now. It's quite intense for them, unfortunately. That's never the plan. But we can talk about it and you can sort of see where I'm going. You can see that it is almost literal. The argument here is we have finished our collecting all our samples. We have tested our samples. We have done all the procedures we should do on the different balances. And we've come to the end of our audit. So, and what I will do as well is I'll just open up, let me just see if I can open up an additional PowerPoint as well. Oops, sorry, let me just open up so that I use this page as well. Okay, right. Let me just make sure that my share is still on my study text. Okay, great. Oops. Sorry, 1 second. What happened there? Okay, go down. Okay, great. So let's see, what are we talking about here? We've finished our audit. And as you can imagine, even without me saying anything, there are a few things you can start to sort of imagine and think, well, okay, I've done the audit. Now, where am I going? Where am I going? Now, let's, again, really the first point here is to think about it like this. We have the year end. And of course, the whole point is that you typically arrive for the audit after the year end. And you will spend 2 weeks, maybe 3 weeks on the audit, maybe 2 weeks if you like. So let's take a year end of 31st of December. Imagine you had arrived at the end of January. So you're in January. Now, of course, everything happening post the year end is really referred to as subsequent events, if you like, and that's the first thing you see over here. My pen, hopefully, will because I can't write on this software, but at least it can pick it up. So this idea of subsequent events. So the truth is that everything you are reviewing or you are auditing material from the 1st of January to the 31st of December, but we can see the effects, or we can see events happening post this. We can look at these events and use that to test or to sort of understand whether or not what you're telling us happened during the year is true. And again, you can almost just think about them, if you like. So for example, if you had put in, I mean, let's take, I want to try and do this without, I almost want to almost get it out of you, and then we can talk about this. Imagine, let's take a classic case. And I just want to hear your thoughts, actually, because this is why I said that we can go through the text. Imagine my trade receivables was showing 10 million. That's fine, no problem. Trade receivables balance 10 million. And this was at the 31st of December. And, you know, I had done my tests, done my circularizations, if you like I said, sent out letters, if you like, looked at after-date cash. And imagine there was still outstanding a receivable, say, worth 2 million. Now, imagine this receivable had been outstanding since the, say October or even September, and it was still outstanding. And it's not impossible. People sell on credit. Things are outstanding, and I would have reviewed documentation, of course, regarding in the board minutes, or just to see that, okay, or speak to the financial director, what's going on with this. It's past 90 days, and you're documenting that. You just want to collect, just making sure. Now, here's the thing. Now the question is, it's all about when I turned up. So I turned up in late January. Imagine I turned up in February. In fact, imagine I turned up in January, and I then went back to my office to carry on putting my paperwork together. And then I got a phone call from you that, say in February, that client was now bankrupt and they couldn't pay the money. Now, again, this is a subsequent event. And the question here is, I know we have a standard for it, but again, like I said, you don't need to study the standards to sort of pick up on this. We do not say, well, they went bankrupt in the year. No, we can see, and I might have hinted at it last week when we spoke, we can see clear relationship to the event in the year. So we argue that where we have evidence that's something that we knew of something, we probably knew of something, then we need to adjust, if you like, the financial statements at the year end. Now, the question is, what you can say to people, Oyen, how could I have known evidence that this guy was going to go bankrupt? Well, the truth is, the fact that someone hasn't paid a debt post the normal time period or a reasonable time period. I know we have conventions of 6 months where we write things off in accounting, but 3 months, 4 months, these are all indicators that this person might go bankrupt. And as a result, we then should write off this debt. And that's referred to as an adjusting event. So there is a standard for it. It's IAS 10, but it isn't. It's really prudence, in effect, the concept of prudence. So the concept really is telling you, go back and take out the 2 million from that trade receivable of 10 million, write it out. So as an auditor, I would make a list of adjustments I felt that the financial director should make, and those would be one of them. Now, he might say to me, but Oyen, so the question here is that, is it material? Of course. Say, for example, it was for £100. Well, if you and I remember, we have benchmarks, and typically profit before tax, for some weird reason, this is one of my, because it's such a common one, 5 to 10% of profit before tax. If that figure is 5 to 10%, is between the 5 to 10% of profit before tax, it is material. So if that 2 million is 5 to 10% of profit before tax, then I would say to him, sorry, you have to adjust this. Otherwise, what we'll be talking about in chapter 12, what I'm going to say, I'm not going to be happy. I wouldn't be happy to say that your accounts are true and fair. So those are the type of things we're talking about. I mean, they typically would turn up after I've left the organization, and I'm in the office preparing before I prepare my audit report, if you like. That's the thing. So let me just get the timelines in your mind clear. I've gone year-end 31st. I've turned up in January, done my audit. I go back to my office. We sit there, compile all the information. Say we compile everything, say for the 31st of March, sign everything off, write our report. We send everything back to the client so they can insert our statement in their annual accounts. So like most accounts, of course, when you see the big account booklets, you see they would have the auditor's report in there. And they would release those financial statements maybe a month later or 2 months later. So it is possible that after sending our audit report, this information might have come out. Do you see where I'm going? So the question here is that we need to still be acting, if you like, and speaking until the financial statements have been actually sent out, even though we have finished our report. You know, we couldn't have known, but I'm trying to alert the shareholders and stakeholders that, listen, there is a problem here. And so the directors should be doing everything they can to amend, even though I finished my audit report, because that's not too difficult. I can always rewrite it, if you like. I can still say, listen, you still need to amend the thing for 2 million, even though I've sent you my audit report. So it's not about, oh, you know, you've sent the audit report, there's nothing else to do. No, you have to remain on a type of duty. Okay, great. So let's scroll through. So the first thing we're going to look at is this question of subsequent events. The other one that you could almost see that goes without saying is this question of going concern. And we'll see that again. It is everything you can imagine. And when we come to it, it is as literal as, you know, as it says. Everything you would naturally, instinctively ask as to whether or not a business could remain a going concern, if they could continue to trade. Everything you can possibly imagine works. You just think it's there. You think they have had a loss in customers, the market's gone south, they've lost. You're basically doing a SWOT analysis. You know, they've lost some internal staff, they need to pay their loans and they can't. Anything that threatens their ability to continue as a business, new laws in place, you name it, it would work for going concern. But anyway, so let's so first of all, this starts off this idea of subsequent events, this idea of what I was talking about here, where we talk about adjusting and non-adjusting events. Adjusting events are those where we would actually go back and amend our financial statements and actually rejournal and change them. And that's the key, that's the first thing. Now, a non-adjusting event is anything where we just could not have had any evidence. We could not have known. And we do not go back and change the accounts. I have a feeling this might even have come up at AAT. Any remembrance of this at AAT? Natalie, Graham, any hint? Adjusting events, non-adjusting events, sort of thing. No. Okay. Hello, are you there? Is everyone there? Oh, no, right.
Yeah, we're here.
Oh, okay.
I'm not sure.
That's fine. Yeah, I just don't remember. I mean, sometimes I know it creeps up in certain syllabuses, but it's fine. I know definitely James, but James only did an AS with me. We do it at A levels, definitely. I know that we pick up on it at A levels, and you definitely, I'm sure, definitely, Hannah and James, you will have seen this on your university syllabus. It just seems the kind of thing that I think would have crept on to the syllabus, although that might have been a little bit of a while ago. So this idea of a non-adjusting event typically is a case where you just could not have had any evidence. And it's happened. Now, the truth is that we must still make our client aware of the situation. So it doesn't mean that just because we don't go back and amend the financial statements, we don't do anything. We still have to disclose very clearly to our clients to our stakeholders of what has happened, if you like, and we can discuss these ideas. So let's look at some of the examples here. So see, there's some classic adjusting events. So and again, the key point here is that these are events that provide additional evidence relating to conditions existing at the reporting date. So we have new information, if you like. And so what we do is we adjust the financial statements to reflect the new information. That's very, very, very normal. We should go back and do that. So, for example, here, this allowance for damaged inventory and doubtful debts. Last week, I talked about, there were a number of things I mentioned. I talked about the fact that if you look at the sales of certain inventory post year end, and it's less than the cost that's been recorded in the accounts, you have to go back and adjust. That is a valuation issue. If we look at post year end and you feel that if the argument is, I mean, this idea of doubtful debts is really the argument that you think that I'm going to lose. Say, for example, you have 1 million trade receivable and you believe that you're going to lose whatever, take 10%. So you expect to get 9 million. So you have 10 million, you expect you're going to get 9 million post year end, but actually you only receive 7 million because we felt that actually more of these debts, like what I was just saying here with the way the person went bankrupt, that as well, debatable though, but we should be asking that you adjust it because we can see that post year end, that allowance has to increase because we can see more bad debts coming through and people refusing to pay. But a number of things. So we talk about insurance claims, agreement of a tax liability, and any errors or fraud revealing that the financial statements are incorrect. So typically where we have any errors, I mean, errors, we always go back and, but I want to keep highlighting what we're talking about here. Where we find errors, we should go back, of course. We have standards for that as well. But again, because the errors in general are retrospective, we should go back and correct it. But let me be, again, like I say, let's be honest. If the errors for £1, if we're talking about £1 billion business and it's just not material, well, no, we won't go back and adjust it. But we should disclose if we feel this was so let's put it like this: if it was an error of £1 and it wasn't fraud, there's no need to do anything. So I'm trying to get you to get your rational head on. If it was as a result of a fraud, I still wouldn't go back and adjust the £1, but I would disclose. So the key point here is that fraud is fraud. The key point is there's a problem with the controls. So it's still important to get to disclose and for management to highlight what they are doing to manage the situation. So yes, these are adjusting events, but they are still subject to materiality. But again, like I said, and I say the key point is always just asking, well, does this relate to the previous year? And were we just waiting for something to come through? And if we were, yes, then go back and adjust. Now, the most famous example when we talk about non-adjusting events features with inventory and the burning down of the warehouse. It's probably your classic case here, loss of non-current assets or inventory as a result of fires or floods. To really help explain the difference between could we have known? Well, if your warehouse burns down unexpectedly, well, it does. It's you could not have known that it was going to, as long as it's not fraud for insurance purposes, and that's not usually the case. Not usually. So you just could not have known. I mean, even this case of the, I think it's really more asking if there's a shock of sorts. So even like this COVID that we've just been through, it turned up in, I think, well, February, March, we were discussing this. So companies that had year ends for 31st of December that just weren't able to move their stock. I mean, there was a lot of talk about Primark cutting, I think, although they refused, cutting their prices. Of just, you would have several, I mean, just think about the restaurant business. I mean, I think I saw something yesterday about how they were challenging this quarantine business and how you were going to create the 2-meter rule in pubs or something, and pubs not being able to show football or whatever, they have to use their gardens or whatever, just because, and they would have had stocks of food and stocks of things. So definitely they would not change their financial statements. No, they would just disclose, and then, because these are events they could not have foretold. So that's typically the case. That's the first one. And so typically events that happen on their own, so like issues of new share capital, any major reconstructions within the organization, we consider to be non-adjusting. I mean, this one is also interesting in that if before the year end, so if in October the organization says, listen, we are announcing the fact that we are restructuring and we will lay off X number of people, and they announce it, well, and then we think this is the amount, well, then yes, they put a provision in. That's fine, right? The fraud here, again, you can see this has been reactive, is that people, what directors used to do is to wait to the year end, notice and see, oh my goodness, you know, they're basically waiting on the results before they make certain announcements. And they now say, listen, we intend on restructuring, but this was all relating to the previous year, so we want to go back and start adjusting. HMRC are like, no, you can't do that. If you intend on doing any of these things, you need to make your announcements, very clear announcements, prior to the year end. But if it's post the year end, it's more about the announcement of it as opposed to the actual activity. So these are some examples, but you will always be told, you'd be told very clearly as to whether or not the type of event, or what you would know if there was an event happening. So another example that's also very popular, I think I might have used it, I think I even used it last time, this idea of contingent liability is very popular. The idea that we're awaiting a court case and we don't know the results. So of course, the court case happens during the year end. So anything that happens post the year end, if the results come out, well, of course we should go back and adjust because we've been waiting. So you can see that's this relationship of evidence. We're waiting. Unlike the fire, we had no understanding. It just happened. So that's a good way to clearly separate I knew or I have evidence versus I have no evidence. Right, so subsequent events, this is what I was saying earlier on. So here, of course, between the year end and when I sign off my report, of course, I am on active duty. I mean, this is the period where we're carrying out sample, where we're visiting the client, trying to get the information together. So 100%, I'm on active duty, and this is where I carry out my audit. So, and anything I find, of course, I will ask to be readjusted or whatever. But again, the problems here arise here is once I've signed the audit report, and imagine I said the accounts are true and fair, and then I send that audit report back to the client to enclose within their annual accounts for them to publish, then we remain on what's referred to as passive duty, if you like, up till the point of them, if you like, publishing. Then imagine we now have this new information. Well, then we must still let the client, because you see, the financial accounts have not been published. So they just need to adjust and we need to issue a new audit report. Or, yeah, I mean, technically if they do what we want, then the audit report can stay the same. But if they refuse, then we will issue a new audit report. Now, even post the financial statements being issued, events can still happen, if you like. So the financial statements are issued, and then in sometime in the future, there will be an annual general meeting, if you like, and then we have an opportunity to turn up there if we still feel that they didn't really do what we wanted, and that's sort of your angle. Okay, great. So this is what I was saying here. Between the date of the financial statements and the date of the audit report, the auditor should perform procedures to identify events that might require adjustments, like I said, or disclosures. You can see the big word here is if material adjusting events. So yes, of course, from a financial reporting point of view, these things should be adjusted. This should be adjusted as long as it's not like one of these policy issues. If someone's gone bankrupt, I'm sorry, you need to adjust the thing. If it's a debate about provisions, okay, I will defer to materiality. I will argue, is it material? Which is why I said, yes, understand the adjusting events, but two, ask the question, is it material? Now, I've said 5 to 10%, but these are just guidelines. So every organization will work to a certain extent of what they consider to be material. So if material adjustments are not adjusted for, or material remember, non-adjusting events are disclosed, and if they're not disclosed, then you will ask management to make the necessary adjustments to the financial statements. If these are not made, of course, this will affect your final audit report, if you like. And of course, this is all happening before I've issued my audit report, if you can remember, like I said, because this new information came to light during that period. Right. So here we are. So generally, of course, in order to understand these subsequent events, I sort of almost brushed, because initially I think I said they called me to tell me that. Sorry about the noise in the background. It's the heat. They need to go out at some point. I think I said to you, they called me to tell me that a client had gone bankrupt. Sometimes you need to do a little bit of digging yourself, and typically we have questionnaires that allow us to tick the box, and I'll talk about what we refer to as written representations. We inquire of management anyway and ask them, is there anything else we should know? Are you telling us the full truth? So typically what would happen is I'll type up everything, and then I'll get them to sign and say, you have told us everything. Of course, I have reviewed the board minutes, the directors' minutes, the minutes of members. I've carried out some analysis. By looking at those aged debtors, I have carried out my receivables. So I have done my own element and work testing. I have communicated with your lawyers. Hopefully we'll see some of those points later on. Communicated with your lawyers, looked at the covenants. So nothing should spring out, but of course, who knows? These things can happen. And this could even relate to going concern, if you like. Yeah. So what am I doing, and how do I actually get these things? I'm going to speak to management directly that they have, told me everything. Look into their systems for the identification of them. So typically, it's, and I mean, this one is really for businesses, organizations that have good internal auditors, because they do a lot of this as well. So whilst you're looking for it, the internal auditors as well are looking at subsequent events that are affecting the financial statements. So that's what they mean really by having management procedures or systems for the identification of events after the reporting period. Because remember that as much as we are not really the problem, the auditors, public opinion really will, to a certain extent, matters regarding organizations. I mean, look at what happened to Tesco's. So if people feel that, oh, you have been fraudulent in any way, or you haven't told the truth, then we see people offloading their shares. So internal audit departments are working very much with the organization as well. So it's not just whether or not they're trying to hide things from external auditors. So I mentioned talking about the minutes of a meeting and directors' meetings. I talked about this question of budgets and forecasts and cash flows, and we'll see if this maybe matters a bit more when we talk about going concern. But the key point here is that So some of the key ones, like I said here, written representation, this will come up again and again, and you must be comfortable with this expression, written representation. What is that? That is a letter from management confirming that there's nothing, there are no problems, there are no issues. Really, typically, we write it up, it's printed on the client's letterhead, and they sign saying that we have declared and told you everything that you need to know, and we take full responsibility if there are any issues. I talked about correspondence with legal advisors. I mean, in an exam, you can't write all, there's just no time. But I think if you write the key points as they come to you, again, I talked about this idea of inspecting after-date receipts from receivables. This is this discussion about provisions, trying to understand, because I can. I mean, I'm not expecting, again, you know, without wanting to labor the point, if you have 10 million at year end, typically we have a 30-day window, right? If I'm looking 3 months into it and I'm still seeing that you've not received certain, you know, debts, then I could 90 days. I'm calling that into question, thinking, when did you actually sell this product? What's going on? Okay, great. Inspecting the cash book after the year end for payments and receipts that were not accrued, and inspecting, like I said, the sale price of inventories after the year end. So I'm looking at all these things as post year end events anyway, to sort of see what's going on. Okay, great. So I've issued my audit report. Again, like I've sort of given you the bulk advice here. The argument is that if there are some subsequent events after my report, I'm still asking them to change them, to amend them. And if they don't amend them, then I need to modify my opinion. And I will, you know, so really, you know, so I'm really telling the client that, listen, do not issue the financial statements. If you have chosen not to do that, we want to issue a new audit report. Not that difficult. We literally go back to the same thing and just say we're not accept the accounts are true and fair, and send them for inclusion in their financial statements. Whether or not they choose to listen to that, to be honest, I've never seen any scenario where it gets that hectic, but I imagine it can. People usually come to an agreement in the end, right? But you must be happy to write about the fact that you must seek legal advice if your client refuses post your audit report to change things, and still go ahead with issue the financial statements, because now that is fraud, because they are issuing an auditor statement that is false. So this is no. So this is now, I mean, and then it goes on to talk about the fact that if you do now have the financial statements have been issued, and you now see there's a problem, then what you still need to do is that you really want to, I mean, I think the key point here is that here it says issue a new audit report, including an emphasis of matter to draw attention that the financial statements have been reissued. So, I mean, really, I guess the question here is that, think of it like this: just because a set of financial statements have been issued to shareholders doesn't mean you can't have post correspondence happening after that. It happens a lot. They will issue their big book, and sometimes you have errors, and you'll get in the post another document saying, oh, sorry, there were errors on this sheet and this sheet. And that's typically the process. So even after the financial statements have been issued, you want to see, if you like, that happening post. The same process, you just want your directors to amend that particular area. And if they amend it, well, your audit report technically doesn't have to change. You see, the problem here is that if they don't, that's where there's an issue. Now, here's the thing, and we'll come to talk about this when we look at the last bit. So it says they issue a new audit report, including an emphasis of matter, and we'll talk about that order to draw attention to the fact financial statements have been reissued. So now, when we come to the final report, we have certain paragraphs that try to bring people's attention to particular areas. So again, like I say, a lot of this is dependent on how compliant the client is, you see, because if the client is just amending, well, there's no need for us to do anything. if you like. All we have to now do is just sort of now say, well, just so you know, because you see, it's about being honest with the stakeholders, saying, listen, we issue a new audit report, but we're not saying the accounts aren't true and fair. The accounts are true and fair. We're just highlighting for you under this additional paragraph called the emphasis of matter paragraph, which will come to see that we reissued the statement because there was a change here, but the accounts are true and fair, but so that you're fully aware that we reissued. So whenever we want to bring to attention our clients to a certain piece of attention, then we create this. Sorry, 1 second. Sorry. Apologies. I actually thought they were upset. They were actually playing. There you go. There you go. Okay, great stuff. So, and I've promised them ice cream. That's the only way to get them quiet. So, let's look at this. Let's look at this question, which is what I was saying, so just to make it a bit more practical and to get your thoughts on it. So I'll read it through, and I just want you to sort of read it as well, and I'll just get your thoughts and what you think. So just to make it as practical as possible, and just be accountants about it. Don't think there's nothing hidden or anything crazy. On the 2nd of January, you have this business called Golf Is Us. A major customer was placed into administration owing 211,000. So we have that. That's the first thing. So the question here is that this is on the 2nd of January. I mean, this is actually really good because literally this is, if that's the year end, this is still happening very well when we arrive. So there's no real complication. It's out there for us to see. Hopefully they would have told us. We might have picked it up in the minutes, the board minutes. Hopefully you would think that it just wouldn't be left alone in age receivables when you turned up, but you would probably be aware. Then they tell us that on the 3rd of January 2005, a sales director leaves the company. The director is suing, if successful, the claims amount to 280,000. Okay. Then there was a fire at the premises of the third party, which destroyed all the inventory, and approximately 1/2 of there was stored in these. The total value was 1 million and a bit. Okay, great. And it says here that the financial statements include a 40,000 provision for an unfair dismissal case brought by ex-employees of Murray Co. On the 7th of February, a letter was received from the solicitors that they'd be willing to sell out of court for 25. So they had they had put in a 40,000 pound provision. So debit expense credit provision, they put that in, but now they'd gotten some news that actually, so you can see we have evidence. Well, sorry, we're not helping you out there. We have something, this has happened during the year, so we now have some more information on the 7th of Feb for 25,000. So they now give you this, they give you the financial statements. So what you could, I mean, I've seen people actually, when we see the mark scheme, you could, what will ensure you pass the exam without a doubt is to always respect the numbers that you've been provided. Because in financial reporting, we don't speak about materiality, you see, in financial reporting. We just speak about adjusting and unadjusting events. But in auditing, we have to think about materiality. So you have to kind of show the examiner that you understand from a material point of view the extent to which you would adjust. And you could push and say you could still disclose. I don't think there's a, I mean, I don't think you lose marks for being prudent, really prudent, you know, because you might just be thorough, you know, so as opposed to saying, well, that's what the rules say. So let's look at the first scenario. The first scenario says here that that on the 2nd of January, we have, so I guess the first question here is that I'm only going to focus on profit before tax. We can talk about the rest, but I just want to focus because this is the main one. This is the one, if I drum into you all the time, then you'll remember it. And then overall, because talking about all of the three all the time, I think students tend to forget, but it doesn't matter if I drum this one. So materiality recommended is 5 to 10% of profit before tax. So if a figure is more than 5 to 10% of profit before tax, so in your mind, what you want to do is you want to sort of, it depends on how you do it. It's up to you. You could say, I'm going to take 5% of, or well, whatever, I'll take whatever 5% of 1048000. So that's 52,400. So you can say anything between 52,400 and 104,800. So you might say, okay, that's anything in that range is material. You could look at it that way, which is fine. That's one way of starting. So you just get that. So you're saying if anything is between this type of, you know, amount, definitely it's more than 104,800. You're like, okay, then that's your material benchmark. Are you with me? So you want to show the examiner you're not just fully aware of that scenario. Okay, great. So and that would be enough. So sorry. So let's look at the first scenario. So it says here that this company was placed into administration owing 211,000. So let's go to James. What are your thoughts? What would I do with this? What should I do with this 211,000 from regarding Gulf is Us? Hi, James. Can you hear me? Is James there? Oh, James might not be there. Okay. All right, Dudley. Oh, can you all hear me? Oh, yes, Dudley. Dudley, can you hear me? So yes, given that materiality is 100 and well between 52 and 104, your thoughts? How would you tackle this?
Well, we'd need to obviously where we're still on active duty, have to
Perfect.
sufficient evidence.
Yes, good.
And therefore, obviously, have to include it in the accounts in the final report that takes place of inspection.
Good. Yes. So exactly. So you would, I mean, because it's, thank you. No worries. James was just on a work call. So yes, definitely, because it is material, and you had evidence. I mean, they've been on your books prior to the year end, so you would adjust. It's an adjusting event. You would go back and you would literally debit bad debt expense and credit trade receivables, deleting or removing this balance from your accounts of 211. So that's the first thing. So that's what you want to make the examiner very aware of, that you know that. So you're not just highlighting the fact that it's an adjusting event. So those are the words you want to highlight. This is a subsequent event. You're on active duty. It's not even it's passive duty. We're not even in that phase. Everything here is on active duty. To be fair, I think with you guys, what they will tend to do is, I don't think they'd ever give you anything on passive duty. It's just the awareness of what step to take on passive duty that you would keep pushing. Otherwise, you would issue an audit report that said the accounts weren't true and fair. Right. So, and that's that. So that's the first thing. So we would definitely, that's an adjusting event. We have evidence. We have evidence. This is interesting. The next one is interesting because it's funny because I haven't looked at the answers yet, and I'm interested to see how they go with this one. But just to show you that I don't think it's about that. I think it's really how you argue it. So this time on the 3rd of January, the sales director left the company. The sales director is suing for constructive dismissal. If successful, the claim amounts to 280,000. So kind of let's go to Graham. I mean, yeah, oh yeah, I didn't say that because you're based in you work in a legal field with, or I know you're an accountant, but I know you work in the your thoughts. How would you approach this to decide whether or not this is an adjusting event, is not adjusting, and what would you do depending on where you went, if you went adjusting or if you went non-adjusting? But how would you analyze it in your mind?
Yeah, definitely, because it's taken place after year end. I'd say it's a non-adjusting.
Yes, good point. Yeah. And you would, and then, so how would you just, I mean, I'm just trying to extract it from you. And so what would you then demand of the directors do on the financial statements then, since it's non-adjusting? D starts with a D.
Disclose?
Yes. Yes, correct. So all non-adjusting events must be disclosed in the notes, even though, like you say, you will not be what's the word, putting a provision through. And we can see it is material, right? It's material. It's 280,000. So I always think, just take that 5 to 10% test. In your mind, if you have 5 to 10%, you've won. You know, the others, yes, there's 1% here, and there's whatever, half to 1% of revenue and all these. But just get the 5 to 10% of profit, and you're there. You know, you've sailed away. You do that. You then ask, is it adjusting? Is it non-adjusting? If it's adjusting, I'm going to put it through. If it's non-adjusting, I'm disclosing.
So, Owen,
yes.
Would that still be a provision? Would they have provided for that 280 then?
Good point. You see, this is the next point. So the problem here was this. It says on the 3rd of January, there is no information as to whether or not. So yes, I would have started looking at some paperwork. Was there a dispute before the year end? Now, he hadn't resigned. I mean, it feels like it is unusual. Actually, it isn't. People resign. I mean, you know, it could be a shock. So Natalie, so here's the problem. Say, for example, he had resigned. There were talks and he had said he was leaving. Say there was any evidence prior to the year end, then we could put through a provision. Definitely, if he had resigned before the year end, we would put through a provision.
Okay, that makes sense. Yeah.
Yeah, 100%. If he had said, I'm resigning before the year end, whether or not we've paid him or not, because the question, the thing says that he is suing, if successful. So there is enough evidence that this might be a provision. And what's the worst case scenario? You rewrite the provision, reverse the provision. But you're right, which is what I was saying. So even if you weren't sure, what you're showing the examiner is, if you said, listen, with more information, because again, these things aren't quite black and white. It is, people don't write just, I mean, but people do. You know, maybe they just wake up, it's a new year resolution. I'm going to the Bahamas. I'm tired of living in England. Hey, he's resigned. Oh, no, sorry, there's a problem. Sorry, he's suing for constructive dismissal. So it's odd that, you know, so I still feel that they're just being academic here. Yeah. Okay, great. Hannah, your thoughts on the inventory? I mean, this is massive, 1 million. There's no question about that being material. Your thoughts there? How would you deal with that? Adjusting, not adjusting? Oh, yes. Hannah, are you there? Oh, right. I think I lost Hannah as well. Okay. All right. Yes. So here we have a case of a fire, and we have here, definitely this is a non-adjusting event. You could not have known that your fire was going to happen. So this is a non-adjusting. This is a non-adjusting event. Yeah. So this is a non-adjusting event. That's that. Now this one here. Here we have this. Provision. So really what we're saying here is that we could readjust for 15,000. From a financial reporting point, yes, that's fine, but we don't need to push them because 15,000 is not material at all, right? So this would not, whether he chooses to adjust it or not, it would not affect our opinion on the matter. from a financial reporting point of view, yes, you should adjust this. But whether he says, oh, we can't be bothered, it's fine, it's only 15 grand. And I'm like, yeah, that's fine. It's okay. It's not material. It's not material. Cool. Great. Okay, good. So let's carry on. Okay, let's carry on. Good. So those are subsequent events. Going concern, like I said earlier on, is popular enough. We have been discussing going concern through our entire career in accounting. I think the first thing I always want to highlight when I talk about going concern is that going concern, I know it sounds a bit brazen to say going concern is not about profit, but going concern isn't truly about profit, no. Going concern is about cash flow, you see, because a business can remain unprofitable. I mean, for those of you in practice who have been doing accounts, I'm sure you've seen many businesses that are technically unprofitable for many, many years, but continue because they're able to meet their day-to-day obligations and pay their liabilities and, if you like, pay their workers. So that is the problem, really. That's the definition of, when it says a business can continue for the foreseeable future, I would usually like to add, and can pay pay their short-term liabilities, which is why we typically look at going concern over the next 12 months. So we ask the question, let's look at going concern over the next 12 months. And like I said earlier on, what we're really trying to do here is that we want to see whether or not this business can continue. Now, the first thing I want to say that we will see when we get to chapter 12 is this. A business can, the first thing that we always do, if I asked you what the first thing you would do to look for going concern, it would be the forecast. Every business must prepare a 12-month forecast from the year end. They must prepare it. I'm sorry, we're not even going to talk if you haven't prepared a 12-month forecast, because that's the strongest indicator of your intention to continue as a business. Now, the beautiful thing about it is that if I turned up in month 1 or month 2, I can compare actual to budget, if you like. So I have even more evidence to test going concern. So if you've falsified or created some fancy budget that makes absolutely no sense, then I have evidence, because I can compare what's actually going on to what your budget was. So that is going concern. And like I said, that as creatively as your mind was to go on going concern, you are correct. I don't think we could discuss all the issues that determine whether an organization is, if you like, what's the word? Has going concern. Again, this just highlights what we know already. We prepare accounts based on going concern. There's nothing new there. If you don't prepare it on going concern, we prepare it on a breakup basis. The other point I wanted to make here was this. So sometimes it's good you make these things out of context. Imagine I was preparing the accounts for the year end, 31st of December 2019. The business actually, and I think it's actually a very good example. This is really, in fact, our current situation is big, is critical. So, for example, my barber has been all right, but most of the barbershops many barbershops have closed, just shut because of the COVID situation. Now, year end 31st December 2019, the accounts were amazing. They made a lot of money. The accounts are true and fair. There's no problem. The accounts for that year end are true and fair. Now, what we're doing here, right, this question of subsequent events, this whole matter of looking post year end, is we're looking, well, what's the situation, if you like, over the next 12 months? Well, bleak. So I repeat, the accounts are true and fair, but I bring again to the attention of the stakeholders that this business, unfortunately, will not continue or cannot continue as a going concern for whatever reason it is. So that does not affect the accounts themselves, but it does mean that we need to, again, via something similar to an emphasis of matter paragraph, highlight separate from the, because we'll talk about an audit opinion and we'll talk about the audit report. So we have the audit opinion, which we give on the financial statements themselves, and then we have the audit report, which has other elements to it, such as, of course, emphasis of matter, bringing to attention particular areas, going concern issues, if you like, that have nothing to do with the past, of course, but to do with the future. So that's the that's kind of what going concern is really trying to look at, if you like. Right. So let's look at some of these. So I mean, they talk a lot about if at the year end you didn't think you were going to be a going concern, if for the actual year you weren't a going concern, you would have prepared your accounts on a breakup basis, right? And this is just all what we could sell your assets for. You're not going to get that. What you're really getting, what you will get in the exam is we've prepared our accounts. We're now looking post year end. What's the situation of this organization? So I said earlier on that it is directors who assess the company's ability to continue as a going concern when they prepare the financial statements. And then typically to do this, you need to prepare a forecast. That's your evidence of showing that you are maintaining relationships with your customers, with your suppliers, your supply chains remain intact. Again, like I say, you think of it and you cannot be more creative when it comes to looking at going concern. So let's look at some of them. So you prepare your forecast. If you are aware of any changes, again, without wanting to label the matter, changes in your customers, changes in suppliers, new laws, new regulation that will affect your business. That will affect your business. That will affect your business. So what you want to do is you want to make sure you highlight those, you adjust to see whether or not you can continue to trade. So so yes, of course. So this question of, I mean, again, this question of can you pay your debts and what are your sources of financing? Those are as big as they're going to get. And the classic test always is when your loans are due, if you like, can you, and we will observe the refinancing process. Is it coming through? Is it okay? Will you now have to pay back some lump sum? Do you have the funds to pay it? All of this matters. Again, like I say, you can be as creative as possible. I think we should start seeing some points soon. But really what we're trying to do is to gain enough evidence. And this bit probably is, like I said, is what you'd find more the audit seniors or audit managers doing out of experience, because they would start to know. It's more a combination. It's not one rule, a combination of issues that will determine that, yes, this company can continue as a going concern. Let's look at the examples. Like I said, this is a list that is just non-exhaustible. So the first one here is that your net current liabilities, your inability to meet your debts as they fall due. So you might start to see letters from suppliers. I mean, it is almost anathema not to pay your staff. Once you cannot pay your staff, every year I say I'm going to check. But it's good I have Graham here. I mean, you might not know. I've always been interested. Graham, is there a legal? Is it against the law? I mean, that sounds a bit strong. Is it against the law to not pay your staff on time? Imagine a normal business. Imagine me as a teacher at Chichester College. If Chichester, for whatever reason, they said, oh, we don't have any money and we can't pay you this month. You'll have to wait till next month. Is that okay? Sounds silly. Sounds like.
I'm not actually sure. I don't know if it's against the law.
Yes. Yes, it's an because I always wondered, like, because what do I do? Do I just say okay, or do I just say I have to wait? It's something I've always thought I was always going to ask regarding this inability to meet your debts, because your workers are, you are suppliers of labor. Fair enough with because you can't pay them in kind, you have to pay them in cash, which is why this going concern matter is such an issue. And I've always said I was always going to check that to find out what legal recourse staff have if you can't pay them. I suppose we have the furlough example now to give us some guidance, because I guess the government steps in when organizations can't pay. Okay, great. So that's the big one. You can't pay. Again, like I say, all these points are almost obvious. You can almost think it's possible. Borrowing facilities are close to expiry of the current agreement. You're defaulting on your loans. All this is evident there. The fact that you can't repay loans is evidence that, you're struggling. You're looking for cash. And when people start looking for cash, it is not, it's not so different to real life. People start selling off their assets. When you have unplanned sale of non-current assets, missing, see here, failure to pay staff. Failure to pay staff indicates a significant lack of working capital. Negative cash flow, so you are selling on credit and giving extremely long terms, and you're not able to recover the money. You're not able to recover the money from your customers. So, and I mean, I have, yes, definitely, I have seen cases where I've seen like lots of paper from every so for example, an organization might owe someone money, and then there's still the debt on, and you see all this paperwork coming through, and you see late tax payments coming through. You're not able to pay your way. So we start to ask the question as to whether or not you are a going concern. So and of course, as you know, I mean, like I said, everything, there's just too much. Your inability to obtain credit from suppliers suggests that your payable days. So I would have done my analysis already. I can already start to see that trade payable days are, if you like, longer than normal. I can see that trade debtor days are longer than normal, because you're trying to sell as much as possible. Major technology changes. So yes, this is a big one. Of course, this one is, and we have seen this happen, haven't we, on our high street? The failure of many organizations to go online and to put that as a core. I say core, not just a side bit. A core part of their business means that they have struggled. So we see a lot, so legal claims, loss of key staff. Like I said, I cannot. The other one that's also important here is just to do with trade. If you rely on a particular client for a lot of your trade, I mean, even in audit, we talk about 15%, right? We say that if you're reliant on anyone for 15% of your income, then you need to declare this, ethically. So because as you can imagine, you see where I'm going. So if there's again, from a SWOT analysis, if there's new competition, if you like, out there, then you are in trouble. Uninsured, changes in the law and regulations. So almost like I said, like a pestle. Or maybe I'm making assumption there. So when I say a pestle or a SWOT analysis, pestle, political, economic, social, technological, legal, environmental. These are all shocks, external shocks, that if there was literally nothing you could have done, fair enough, but it has affected your business. And then of course you have your internal, your kind of SWOT analysis, people leaving, things happening within the organization, people leaving, technological systems that aren't able to keep up, that sort of thing. So you think about, this is why I say maybe someone more senior would be looking at this, and the combination of all of this would then allow us to draw the conclusion as to whether or not you were a going concern or not. We would still issue a set of an audit opinion that said your accounts were true and fair, but our audit report will highlight the fact that we don't believe that you are a going concern. Sorry, we're going on a break soon, and I'll sort this out. Audit procedure. So, what do we do? So, so we need to evaluate, of course, management's assessment of going concern, and you, again, it has to be 12 months. 12 months is what we consider. So like I said here, what am I saying? Everything. I mean, again, like I say, look, these are good. These are audit procedures. And yes, actually, good point. So typically, I've been talking a lot about audit procedures on the actual accounts. These are the audit procedures you can get asked a nice. I mean, it's a great question. It's a great question that has absolutely nothing to do with all the core details. It's almost like you could think of them. What kind of documents would I be looking at if I wanted to know whether this organization was remaining a going concern? Like I said, I've talked about the loans, I've talked about contracts, I've talked about legal cases, I've talked about tax, you name it, you get the mark. So I've talked about the forecasts, I've talked about the reasonableness of the assumptions. When I say reasonableness, what does that mean? I can carry out various analysis on actual versus, if you like, a budget, to look at the variance. And it's so easy. I mean, I think in performance management, we talked about sales budgets. I can break down. These budgets can be broken down into the different products you're selling and the prices. We can analyze this. It's all there. It takes a bit of time, but you can. And of course, the organization might have prepared a 3-month financial set of accounts, if you like, just before you issue your report. Look at the loan agreements, if they've been breached, minutes of meeting, speak to the lawyers for litigation. So I review correspondence with customers for evidence. So the list just really goes on. Look at issues of payment. You'd have done your analysis. It's not here. Indication of the bank loan or overdraft may be recalled. So you can see that that your focus should be on cash flows. And when I say your focus should be on cash flows, you can see that there's a lot of things we could look at. And what you want to do is you just want to get, by the time you write a few and then you do another exam question and then you write a few more, you start thinking all the audit procedures. And of course, you want to be specific to the question. It might be a particular area that might be focused just on debts and loans. So you want to speak about making sure. And you want to see, the other thing that's not mentioned here, but it's critical, is that many loans are secured on certain assets. So the problem is, certain key assets. So imagine there is a threat to your main asset or to your main machinery if you don't pay a loan. You can see the problem there. So, and you just literally want to be as literal as that, and you're fine. So the focus, of course, like I highlighted again, is on cash flows, right? So I think I mentioned earlier on that in terms of disclosures, so typically, so disclosures relating to going concern are required to meet direct and full. When they're again, so here's the again we'll discuss it a bit more when we get to chapter 12. Now the client themselves must accept the fact, if you like, must disclose, if you like, that there are problems. You see, that I think Graham mentioned the word disclosure, big word, disclose. You see, so the client must disclose, like that was such a long list I talked about. That list has gone from, well, we're having debt issues, we cannot meet our repayments, or we have lost a big client, if you like, or we have lost some key customers, or we have lost some key staff, if you like. That needs to be disclosed, if you like. And so you can see here, it says, where there is material uncertainty over the future of a company, the directors should include disclosures in the financial statements. A material uncertainty exists where there is potential impact, or like where the magnitude of the potential impact and the likelihood of occurrence is that the disclosure of the nature is necessary, and so there's not misleading. So if you like, again, what we then do is, if they have disclosed, right, then we will say, yes, the accounts are true and fair, and we will still bring to the attention that, listen, guys, you know, in there's a problem here in the audit report. But that disclosure is required by the clients. What is not good is, what will not be acceptable is if they keep on saying, listen, everything is fine. Then what we cannot do is say, oh, the accounts are true and fair, and then just show that emphasis of matter. No. We accept you have disclosed that the future doesn't look so good. You have highlighted the issues as whatever they are. And then we will now say, yes, what you are saying, including your disclosures, are true and fair. And in effect, that we will then make this note in this other area in the audit report. Cool, great. And that's really the key point that I wanted to highlight there. Let me just see here. Yes, I think what we'll do is, yeah, I think let's take a break. It's quite warm, and we'll reconvene at 11 o'clock. Okay, listen, let me tell you something.
Finish brushing your teeth and go and start starting work.
Boys, Marines is. Look, look. Come on, mate. That's okay. I'll tell you. Okay, right. Welcome back. Just an indication if you can hear me. Yes.
Yep.
Brilliant. Great stuff. Awesome. Great stuff. So just before we left off, I think in summary, but we will discuss this when we talk about reporting. But I guess this is where, again, when I say once you know this, you're passing the exam because you're aware of what those little nuances are. Your financial statements, the numbers are great. Year end 31st of December 2019. Yes, that was all wonderful. But now we're looking into the future and we can see some issues. We've highlighted all those issues. Well, there's a list of them. Now, all we ask the financial directors to do is to disclose these matters as you would expect any if you like dutiful and what's the other word, directors who wish to show faithful representation and acting in the best interests of investors and clients so that they're aware that this company is facing significant or a significant matter or significant issues. It doesn't really matter what it is, ranging from pestle, whatever it is, they should disclose of it. And when they do, because remember, we're not just auditing numbers, we're also auditing disclosures. So if they do that, yes, the accounts are true and fair, and then we give if you like, technically we'll talk about it next week, it was referred to as an unmodified opinion. A good opinion, this is fine, it's unmodified. But if they refuse to disclose, you can see how they are misleading the users or stakeholders. Now, just because we've given an unmodified opinion, because they've given, you can see here, it says the auditors should issue an unmodified opinion with additional communication if the directors have appropriately disclosed going concern uncertainties or prepared the financial statements on a breakup basis. And we'll talk about this more. But we still will go ahead and draw to attention to especially readers because they might have missed the fact that this business, they might have missed those disclosures. Think about it, not a lot of people pick up on all these, look at all the notes when they're looking at financial statements, but it's important that we look at it. So we draw their attention to the fact that the business is not a going concern or is having going concern issues. Right. So here they're talking about looking at cash flow forecasts. Again, I think it's good we just go through them so that you kind of, I don't think they're not new for you, but so that you're aware of them. So what are we talking about? Like any forecast, if you ever, I mean, it's an engagement in itself. It's an assurance engagement. It's not an audit, but it could be an engagement. You could be asked to review set of financial. You're really looking at the integrity of the forecast ultimately. And what does that mean? We want to compare. We want to understand who's done this forecast. That's the first thing. We want to look at the reasonableness of this forecast. And when we say a forecast, we're talking about sales, all like a cash flow forecast. Nothing, all the sales and then all the cash coming in from sales. We want to see all of that. We want to see all the expenses going out. I would go as far as saying treating it like management accounting, if you like, comparing actual to budget, if you like, and to see if that already starts to pick up. That starts to pick up on those issues that I mentioned earlier on, as to whether or not you're exaggerating your budget with sales and we're seeing what's actually coming in. And looking at the timing. Assessment of non-current assets. So this is another interesting one. If you remember, with a cash flow forecast, there would always be in your expenses some element of some new acquisition of assets, how they intend on funding that, and what cash flow. A lot of this, all your questions. I highlighted it again. All your questions, everything. Every time you speak, you want to speak about cash flow. Cash flow. Are they able to meet their cash obligations, if you like? For example, here it says, for the acquisition of buildings, agree the timing and amount of cash outflows to the expected completion date, compare actual performance to forecast figures, recalculate the cash flows to verify accuracy, inspect board minutes for any relevant issues within the forecast. So the same way we would attack any forecast, of course, you connecting it to the question, that's important. Okay, great. So again, why I've decided to kind of not go with slides here and go here is to look at some of the questions so we can actually see how we write. I'll go to the answers as well, but how we write about this and talk about this. Again, I highlight your angle again is cash flow first. I mean, you may speak about profit, but your focus is always on cash flow. So the fact here is that this says when you're doing a going concern review for the year end, and you can write liberally. So for example, here it says that golf is a major customer placed into administration. So going concern, the question is asking, using the information, explain the potential indicators that this company is not a going concern. So like I said, it's not the one thing, there's a combination of things. So let's look at, we're trying to create a picture. So one of their customers is going into administration. Now I don't have enough information. I don't know how material this is, but if I was to use last year's figures, remember that their profit, I guess I'd be asking what percentage of their revenue is this in effect, or what percentage of their profit, if you like, is this figure. But from a cash flow point of view, I will not be receiving 211,000. Now, I don't know what the bank account is. I don't know what the balance is in the bank account, but you know, this is money that I will not be receiving. I have lost goods. So this is definitely going to affect our cash flow position. And we need to be asking questions as to, because it's about cash, isn't it? About how much cash is in the bank to meet our other short-term liabilities. Was this figure going to come in to offset a lot of that, to pay wages, to pay other, now I'm short, I can't pay my, in terms of working capital, I can't meet my trade payable liabilities. So those are issues to think about. The sales director has left the company. So again, think liberally about this. This is someone who was in charge of sales. So now we now have a problem with maintaining relationships with our customers because someone who was quite key has been dismissed. Woe betide us if he doesn't take some of those clients with us, or some of those clients leave. We also have the secondary problem of the legal case, so we have another cash flow issue there. Potentially. So those are the kinds of things you're highlighting. We cannot know the entire story, but we're just highlighting the problems here, the complications, the implications here. Sales directors leaving the company is not a good thing. Other potential clients, and we don't know. I mean, worst case, what you're just highlighting is you're highlighting the worst case scenario. What are the chances of him taking our biggest clients or our biggest customers? So you can see that the questions are fair in that you can almost be open about it and just write and think, well, these are things I want to consider. That I would examine. Fire in the premises and destroyed all our inventory. So now we have a lot of our inventory that we, gone. This is an asset, first of all. So either we need to replace this inventory or we need to hold for insurance. So I'm going to be looking at how quickly the insurers are going to give us this asset back. But if I have to replace this asset, then I guess you're saying we have disappointed customers because they were expecting the goods. So these are issues here. How long will it take for that money to come back? That sort of thing. And it says a third-party warehouse provider. So we have to hope they were insured because it didn't happen on our own. It didn't happen on our own in our own warehouse. So we have here the assembly line was refurbished. So now we have a problem. So you took out a loan and that is secured in part on the refurbished line. Now the refurbished line broke down and is still not working. Boom, issues. We have sales not coming in. We have a potential legal issue here where if we cannot meet our loan, problem there. And the main machine that we have here is secured on it. So problems everywhere. Your main source of income is broken. So so what I can see that you're also trying to raise money. So I can see definitely. So I think there's a going concern issue here. You're now seeking new funding through an IPO. If it, if it doesn't, you need to renegotiate and additional funding from existing or new investors. So I can see there's pressure on you to probably manipulate performance measures. What if you don't get it? So I want to see the, we want to be invested. So there are enough indicators here that you are not going to say. That's what this question is asking for: indicators, evidence. I want to see all the letters and all those, and follow the process. And then it says here, this is probably the good one here. You have an overdraft. Here you are of 180. It was 120,000, so it's 60,000 worse. Your limit is 250. So much to write about. You're only 60 grand away. A number of suppliers were paid late. It goes on and on. So the question here is that you might not be able to meet your interest, pay your staff. 60 grand. I mean, there's not much. So if you don't have any money coming in, you probably won't be able to pay your staff. So those are the kinds of things that you can see that they wanted you to write about or discuss. Cool. Right. So so overall, I mean, typically when you've done all your work, so the big post review matters, of course, were subsequent events and going concern. So what you definitely will do generally as well is when you've done everything, you've done all your accounts, you will, I think the first point here, definitely I would start off with, is this idea of carrying out analysis again of all the ratios, again, just to sort of see whether everything is similar to what you thought the case was at the beginning. So for example, you would have calculated GP ratios at the beginning of the year, and you would have calculated trade receivable days before you started the audit. But now, after all the adjustments, you would do all those calculations again and see for yourself if there are no new issues that have come up, because all these adjustments have now been put through. So there might be new risk areas or matters to just sort of be sure of, to see the profitability or changes in profitability, or that might highlight other areas that you hadn't picked up on. So in terms of this final review, if you like, just before you finish, before you finally sign off. Okay, great. So some of the things they ask us to sort of, if you look at, is review the financial statements to ensure that, if you like, they have complied with the accounting standards. I mean, you've been doing this. I think it's more to do with the local legislation. You're just almost using a check. A lot of this is done using these checklists, if you like. Policies are disclosed. It's almost like a final checklist that everything is, nice and disclosed, if you like. We haven't missed out anything really in effect. Again, I talked about analytical procedures just to kind of be sure that, yes, this does look like what we started with when we calculated the ratios at the beginning. There's been no significant changes that we need to carry out any further investigation for. We will look at the aggregate of uncorrected misstatements. So for example, typically what you now need to do is you now need to take a final overall positional materiality, looking at all the little mistakes. So I know I said earlier on that, and I think we saw 15,000 where we adjusted. We said we wouldn't adjust it wasn't material. But imagine you had all these little journals. They were errors. So really what you want to do is you want to look at all those errors, especially all the ones that affect the profit statement. And if you notice that all those errors, after adjusting them, actually have 5 to 10 are greater than, or are in between, again, it's a matter of judgment. I would say, anyway, let's just say if they're definitely greater than 10% together, then you want to ask the client to adjust a few, because ultimately that's your benchmark. That sort of the thing. Or even still, you might, but for exam reasons you want to. But in reality, you'd probably be like, listen, it's okay that these things aren't really affecting the true sense of the statements. That's okay. Again, like, what am I saying? I mean, this is just, just kind of saying what we do. Why do we carry out these reviews? We just want to make sure that we are, it's really quality control ultimately. and to make sure that, because just before we give our final opinion, you want to make sure that you have ensured that you have sufficient and appropriate evidence to form an opinion. Ultimately, that's what you're really trying to do. So you're just kind of sitting back. You'd probably give it a day, leave it, and come back, give it a day, and then have an overview again. Just think of when we do our financial accounting, we write our financial analysis, do everything again, and sort of say, yeah, this business is this is a going concern. These are where the issues are. We've picked up on everything. These numbers are the numbers here. The numbers here that the directors have asserted here are actually true. You can see here the auditor ensure that the initial assessments made at the start are still valid in light of the new information and any new circumstances. So this is what I was saying earlier on, really to summarize this evaluation of misstatements. The auditor must look at all those misstatements and gather them. So accumulate a record of all the misstatements and whether or not they are material. And then typically on all these misstatements, from a financial reporting point of view, you need to adjust. You need to adjust them. And again, like I say, it's a question of materiality. We would like them to adjust them, if you like. It could even be judgment matters on provisions, if you like. But again, it is a matter of non-adjusting versus adjusting, and a matter of materiality that we have discussed earlier on. So, yes, again, like I say earlier on, I mean, again, sorry, it feels like one is repeating, but the key point here is it says that determine whether the uncorrected statements, either individually or aggregate, are material, if you like. You see, so this is the thing. It's a matter of materiality. And if there are all these income statement issues, which is typically the case, we then want to ask the question that you will have to adjust, if you like, adjust a few of these, or just the material ones at least. And then again, the drama begins of whether or not they want to, and then you go to the audit committee and communicate with them. If you like. And then what we then do is, like I talked earlier on about this idea of written representation, we then almost put it on the head of the director, saying, listen, we're going to write that you believe that these are not immaterial, and these are immaterial, or they're not material, which is why you refused to amend them, to adjust them. It never really gets there. Never really gets there. Most of the time, the financial accountant will agree with you and adjust these. And I think so. This is an example here. Again, like what I was saying here. Here you have also kind of carrying on from what we were saying. Here you are the completion stage. You have profit of course, we saw this before, 1,048,000. This is the recoverable. If you remember, recoverable debt, irrecoverable of 211. There was this adjustment of 15. So there were a few more issues here. If you look here. So it says here that so first of all, this on its own, if you look at this on its own, if you remember, was big. It was more than 10%. So I'm sorry, he has to, or she has to adjust that. So there's no question about that. So that stands on its own. The problem, like I said, were all these little ones, on their own. They are actually quite innocuous on their own. But when we now look at the overall adjustment, when you now do the net adjustment as a result of all of this, the overall figure is 80,000. When you now look at if you were to adjust them, and this is material as a whole. So in order to avoid, for you guys in an exam condition, what you're saying is that individually, so this is where I say once you do this, talk about this, you've passed, you're showing the examiner that on their own, they might seem innocuous. If you remember in that very first question, it was only the first one we had of the 15,000. So it seemed irrelevant, it wasn't material. But suddenly we have a few more. So suddenly as we see a few more, it starts to mean, right, we cannot ignore all these individual little bits, which is why the review is so important, because we almost have to wait till we get to the end of the year to then look at all these misstatements and then add them all together and then make a decision. So I've already hinted at the fact that when we are happy with the final accounts and the disclosures, we give an unmodified opinion. But if they don't adjust them, then we end up giving a modified opinion. Right, okay. So this next bit here talks about written representation, and I've sort of highlighted earlier on that so a while ago I highlighted, think of written, I highlighted written, I mean this is written representation in a review context. How this works in practice really is the fact that, say for example, you have some inventory in a warehouse, say on the in Fort William in Scotland. I only say that because I was talking to an old school friend who's from Fort William, and he's back living there. It's right up north, and I've been, I mean, when I was a long time ago, went up there to visit him, actually his wedding. And it's ridiculous because he was like, "Well, you can visit." I was like, "I'm sorry, it's too far." So it's right up there, and you just can't go. Now imagine the inventory is worth, say, 10 grand, but you're a $1 million business. You can't go. So all you do is you basically get the client to write or sign that, listen, I attest that we have inventory up in Fort William worth £10,000. It's not material, and you can trust me. In effect, this is it's information that's come from the client. It's the weakest form of evidence because the client is literally telling you, and you are trusting him. So because it's too little, is it worth the cost of me even getting another auditor to go out there and look at the inventory? No, so I'll just get that. So the idea of written representation is really management really providing, confirming certain matters or to support other audit evidence, really. So, you know, and it might be a case that it might be a court case where we haven't heard from the lawyers, so they can say we're in touch with the lawyers, just to give you a sense of, you know, comfort, almost like a comfort letter. And also a letter of responsibility saying that we take responsibility for this. If anything blows up in the end, we will take responsibility. So let's look at it with regards to the review. So generally what they're saying is that they have fulfilled it. They're basically saying we've given you everything you need. We're not hiding anything from you, if you like. And that we consider these matters, we may disagree, we consider these matters to be immaterial. But again, like I say, they sort of say, we've given you all the relevant information, everything's been recorded, because, you know, people always forget. And so it says a representation to support. Yes, so like what I was saying here, especially when you're using a lot of judgment with provisions, or you're using a lot of judgment in their own experience, especially even with work in progress, you know, they're really telling you there that we are responsible for this. So examples, the selection and application of accounting policies, if you like. Remember that, again, with audit, there's so many different types of businesses. And directors typically are, so for example, think about construction. Typically, many of your directors would be in the field, they would understand the industry, you probably won't. And you think about chemicals, or think about the entertainment industry. So to a certain extent, they do know better, because it's their business, you know, they're running it. So we almost have to accept that the accounting policies that they choose are in line with those in the industry. And that's where we're kind of getting them to sign this letter saying that we know that. Yeah, so whether the firm has measured liabilities, yeah, so they're sort of aware that they have disclosed all the contingent liabilities or actual liabilities, any plans, any kind of, if they've borrowed money and secured on any assets, if you like, any scenarios that you might need to know of. They have communicated all deficiencies, internal control, and generally what you expect, specific assertions about the balances, right? I mean, I know they highlight here that, again, like I say, it cannot be a substitute for more reliable evidence, but if we just cannot get any better evidence, then we will go with a written representation. But it is the weakest form of evidence. And typically what you get is that we write up the letter on, and then they print it on their paper head, and their letterhead, sorry, and then they sign. And that's typically the issue, right? So I talked about that. The fact here is that we're really trusting management, and yeah, I think those are the main. Yeah, I mean, this is, if we can't trust that, the truth is that if we can't trust the directors, we're probably, well, we probably cannot trust their written representation, and then we would have to go and carry out further audit procedures. We're really just trying to just minimize the amount of audit procedures that we carry out here. So the bottom line really is that we need to take steps that if we can't trust their written provision and representations, or their, then we have a problem, and then technically we need to find a way to get that information. And if they won't let us have that information, then we need to we'll come to this next week, this idea of we need to, if we cannot give an opinion, then we have to state the fact that we cannot give an opinion. But we'll talk about this next week. We're really hoping that we can trust them or go and see it ourselves. Something has to give, something has to happen. And it is unusual, but if management refuse to provide the requested written representations, then as you can see here, it just all seems very kind of back and forth. Discuss the matter to understand why they're refusing, reevaluate the integrity of management, consider the implication for the auditor's report. So definitely the written representation is very much part of what we do, very much part of our work, and making sure that we, for those areas where we require minimal evidence, there we are. Right. So this is an example, if you like, of a written representation letter. You can see here, we have fulfilled our responsibilities. Significant assumptions used by us, including, are reasonable. The effective uncorrected misstatements are immaterial. If you like, the basis and amount of warranty provision are reasonable. Like I said, imagine it was a motor car business or an automobile business. To a certain extent, you cannot challenge them for too long on these matters. You almost have to accept, but you can still test it, fair enough. But and that they've given you all the information that you need. And we have provided you with access to all the information. So if anything comes up, we can say you didn't give this to us. And then, if you like, all transactions recorded in the accounting records are reflected financial statements. So there's no fraud. You can see there, they're really kind of giving you a final kind of pass and saying, listen, we have disclosed everything regarding any specific issues. Remember, that case was the dismissal. Like I said to you earlier on, all these adjusting events, we would expect them to give it to us and tell us. It's unusual that we would be going around asking. They would have some record, board of minutes, member minutes, and have all that information there for you. Cool, great stuff. So yeah, sorry, I mean, it's a bit warm. I think we've done quite well in terms of dealing with that issue. So I thought that this chapter was okay to look at from the point of view of going through the material. Wasn't too bad. So what we need to do now, literally, we only have technically reporting left. I mean, this is good. Is to kind of now get into a question mode. I'll tell you how I think. What I tell you works really with this question thing. I've seen over time that most students kind of understand what's going on, but the reason why it's good, and again, forgive me if you've sent me anything. I'm going to check I'm spending my afternoon today going through my mail. So please, thank you if you've sent me any work. I will mark it and get it back to you. But it's so helpful, please, for you to actually do the writing. And even though I think I've recorded a lot of the questions now for you to check your answers to, really, really please do the writing and send your marks, so send your work to me. What I'm going to do is I'm going to send you the first mock. So you know how there's always these mocks they send. I'm going to send you the first mock next week or over the weekend for you to do. And I think it's a short mock. It's called objective bits and written bits. And yeah, please, if you can, try and send that in. I'll mark it next weekend. So if you can send it after our class next week, that's great. So I mark it at the weekend. But now I think it's a time to sort of sit and start doing questions, and then I mark it, because it's the language, especially with the audit procedures. And then once we're done reporting, we will sort of reconvene and assess how we will literally do questions in class, and you'll do questions at home. And I think that's we have enough time. But it'll work well and best if you're doing questions. Honestly, I know it's boring. When I say boring, sitting down and writing, it's not like the calculating ones where at least you can, calculate and sort of play with your calculators. This one, you're literally writing for a while. And don't worry if your work doesn't look like the mark scheme. If I get to mark it, I can show you how close it is to the examiner's report, so the examiner mark schemes. Yeah, cool. Is that good?
Ian,
Yes.
sorry, just very quickly,
Yes.
it might sound a really stupid question.
No,
but
no, no.
You know when you say that 5 to 10% of profit before tax?
Yes,
So if that question said 7.6, I think, percent,
that's right.
that needs to be adjusted then.
Yes, yes,
So
yes,
between 5 and 10.
yes. Good point. So, the problem with the exams and the reality is this: they cannot. The safest thing, I guess, I think, from an exam point of view, I would say 5%. So that means that in your mind, if it's more than 5% of profit before tax, you're asking them to adjust it.
Okay.
In reality, if it's between 5 to 10%, I'm watching to see if there are any other misstatements that will take it over 10%.
Right.
I'm in limbo. I'm thinking, But again, the firm I trained with didn't use these ratios. Didn't even use them. They had their own way of calculating materiality. So it's just a guide, but from an exam point of view, I guess I should really say 5%. If it's over 5% of profit before tax, you're telling them adjusted.
Right.
Definitely. Yeah. No, it's not a stupid question. It's really important because you want to highlight that as part of your writing. I think what you're always trying to show the examiner is this. Imagine you did it and it was 3%.
Mm-hmm.
You could, of course, yes, you don't, now it's not material. So you want to show the examiner, you're saying, well, mathematically, it's not material. So you want to also show the examiner that, well, there might be other misstatements and they would then add up and finally get over the 5% sort of threshold. Now, I guess what you don't want to write in the exam is that maybe you should adjust 1 or 2 to bring it below 5%. No. But in reality, that's what will probably happen. So we would say, listen, so we don't go over the 5%, why don't you, adjust a few so we don't have this problem. In the exam, you would say, well, now you need to adjust all of them, because that's the point. The question here is, why does the client not want to adjust them if they're happy to accept them? They're just saying that it's tedious and tiring to go back and start adjusting, that's all. And we don't think it's that important. So that's the way you're framing it. You're framing it starting off with the mathematics, that it's 5%, therefore material, and therefore has to be adjusted. It's between 5 to 10%. So we need to consider the client has to consider whether or not they wish to, So for us, from an exam point of view, once it's greater than 5%, yes, adjusted. But the 5 to 10%, also because in reality, we also look at the other ones and we say, okay, 5 to 10% of profit before tax, 0.5 to 1% of revenue. So you might take a figure of materiality in between those two. Do you see where I'm going?
Yeah.
As your overall materiality. So it's just that for exam purposes, we've noticed that you can just strike a figure and say, I'm just going to go with 5 to 10% of profit. I'm going to ignore the others because I'm focusing on profit. And as we do questions, we can bring in the others into the debate. So in reality, when we start doing questions, what I want you to really say is, I want you to find all 3 of them, but the 5 to 10% people always remember. I mean, 0.5 to 1% you're now remembering because I'm saying it over and over again. But if you thrive at 5 to 10%, and then straight away you're like, yes, this thing is material. You're not confused. You're like, great, it's material. Adjust it.
Okay, thanks.
No worries. Cool. Awesome, guys. Great stuff. So thank you. And we will finish reporting next week. I encourage you, carry on working on the relevant questions. I think now, really, because when we're reporting, you should be literally sitting and trying to do as many of the objective questions up to reporting, really. just keep going, really, and sit out and just enjoy them if you can in this weather. And I'll see you next week. Yeah.
Okay.
Cool.
Thanks.
Thanks, guys. Awesome.
Thanks, Ian.
Thanks,
No worries.
Ian.
I'll see you, Wade.
Thank you.
See you next week. Thank you. See you next week.
Bye.
Bye bye.